Hey gang, Dennis Tubbergen here with another market update. Today is Thursday, April the 26th, 2018, and I want to talk to you today about valuations in the U.S. stock market. If you look at the article I have on the screen in front of you, it's from Financial News. It was published about 10 days ago, or exactly 10 days ago, and the article is really commenting on or relating to the reader the opinion of Mark Mobius. Now, if you're not familiar with who Mark Mobius is, Mobius was a fund manager with Franklin Templeton for more than 30 years, very highly regarded guy, and he says that the U.S. market, in his view, is set for a 30% correction that would essentially wipe out gains of the last 2 years. So he's talking about stocks here, obviously. He says all indicators point to a large fall in the S&P 500 and the Dow Jones Industrial Average. Now, if I go to another article written here by Tyler Durden on Zero Hedge, and Zero Hedge is a terrific site if you want a place to go just to get some good information. And as you can see, Durden wrote this article back about a month ago. And the title of the article says it's the same this time. FANG valuations reach .com peak. FANG is really an acronym that stands for Facebook, Apple, Netflix, and Google. So Durden points out in the article the valuations of these stocks is about where you would find tech stocks just prior to the tech stock market correction back in 1999-2000. He starts the article by saying it's not different this time, it's exactly the same level of exuberant retail buying the top, the same level of nothing can stop us now, the same level of what recession, and most importantly, the same level of insane valuations for the mega tech leaders. You take a look, you see that the price to sales ratio on the S&P 500 is exactly where it was in 1999. Actually, just slightly higher if you take a look at that. And then if you continue in the article, it says here, but none of that matters because FANG-type stocks have been leading, charging, incessantly bouncing to ever-increasing record highs with all the chatter of bubbles being shrugged off, simply saying you just don't get it. You know, at every market top, when there is a bubble, people tend to get irrational. They say it's different this time, and they come up with these reasons that aren't really reasons at all when you think about it logically. But that's the mindset. So when you look at market sentiment and you look at the mindset of the market today, it's exactly where it was in 1999. In the 2000s, we became averse to equities and all things new economy thanks to the scars of the dot-com bust. What we didn't realize was the credit markets and the old economy were becoming bubbles. It didn't help that we underestimated the size of these assets, as many were off balance sheets or hidden in obscure financial securities. The same can be said about today. And if you take a look at where the S&P Internet Services and retailers are as far as valuations are concerned, and it's the price-book ratio, you see we're right back to where we were when the stock market corrected, or just prior to the correction in 1999. So I happen to think Mobius is right here. History does repeat itself, and we are 17 to 18 years after the dot-com peak, and it appears that we are repeating it again. So again, I think caution here certainly is the prudent move, and if you have stocks, you might consider putting in place some sell stops or even taking some profits. Certainly depends on your time frame, and certainly you should get the advice of a qualified professional. But that is today's market update. I'm Dennis Tubbergen. It is Thursday, April 26.